Welcome to Global Economic Brief, where we break down critical economic trends that shape the world. Today we're asking, why is the US dollar strong right now, even as other major economies struggle? And what does this mean for Europe, currencies like the euro, and global markets? In this video, we use verified data from official sources and reputable financial analysis. No rumors, no speculation, just facts you can trust. Section 1, Dollar Strength. First, let's define what we mean by the dollar being strong. The US dollar index, in which measures the greenback against a basket of major currencies, has climbed to levels not seen since late 2022, according to UBS Global Economists. This reflects broad demand for US dollars in 2025. A stronger dollar means foreign currencies, like the euro, yen, or pound, buy fewer dollars. That can influence everything from import prices to investment flows. Section 2, Why investors still want dollars. There are several reasons the dollar remains formidable. 1. U.S. economic resilience. U.S. economic indicators, like job growth and consumer spending, have remained surprisingly sturdy even as global growth slows. This encourages international investors to hold dollar-denominated assets. 2. High relative yields. Although the Federal Reserve has signaled potential future rate cuts, U.S. interest rates are still higher relative to many other major economies. Higher yields on Treasury bonds attract global capital, supporting dollar demand. 3. Reserve currency status. The U.S. dollar remains the world's dominant reserve currency, accounting for a large share of global forex reserves and international trade settlements, especially in commodities like oil. This structural role creates ongoing demand. These factors help explain why the greenback still plays a central role in global finance. Section 3, Safe Haven and Geopolitical Factors. In times of uncertainty, investors often favor the dollar as a safe haven. Recent geopolitical and economic volatility continues to make the U.S. currency a preferred refuge for capital. Even when markets weaken, the dollar often holds up relative to riskier currencies. However, this trend isn't uniform. Currency movements reflect many moving parts, including trade tensions and central bank actions, which we'll cover next. Section 4, What central banks are doing. Central banks play a critical role in currency strength. Federal Reserve, U.S. Even though markets have priced in some future rate cuts, the Fed's current stance keeps U.S. yields relatively attractive. That draws foreign investment into dollar-denominated assets. European Central Bank, ECB. In contrast, the ECB has recently held rates steady after earlier cuts, reflecting mixed economic signals in Europe. This can dampen euro momentum relative to the dollar. Bank of England, BOE. The BOE has cut rates further while inflation in some European countries remains sticky, adding another layer of complexity to currency markets. These policy divergences influence how the dollar compares to the euro, pound, and other. Section 5, Europe and the dollar. So what does a strong dollar mean for Europe and the euro? When the dollar strengthens, European import costs, especially energy and commodities priced in dollars, often rise. This can put upward pressure on inflation in euro-using countries and complicate ECB policy. At times, the euro can rise against the dollar when markets price in stronger European growth or monetary policy support. But recent trends point to a cautious backdrop for the euro relative to the US dollar. Section 6, Global Reactions and Risks. Despite the dollar's relative strength, there are risks and counterforces. 1. De-dollarization trends. Some countries are actively diversifying away from the dollar in trade and reserves, though this is a slow process and hasn't fundamentally displaced the dollar yet. 2. Policy uncertainty. Shifts in U.S. fiscal and trade policy, including tariff threats and political pressures on the Fed, can weaken confidence in dollar assets. Some analysts argue this factor contributed to dollar volatility earlier in 2025. 3. Emerging alternatives. The euro, yen, and even emerging market currencies sometimes gain traction in short-term trading, especially when the Federal Reserve signals easing ahead of others. These trends show balance. The dollar's dominance isn't guaranteed, but it remains structurally strong due to deep financial markets and widespread usage. Section 7. What this means for investors and businesses. A strong dollar impacts global markets, imports and inflation. Countries that import dollar-priced goods may face higher costs. Exports. U.S. goods become more expensive abroad, which can affect U.S. exporters. Emerging markets. Economies holding dollar debt face higher repayment costs if local currencies weaken. Investment flows. Capital may continue favoring U.S. markets if yields remain attractive and growth appears resilient. Understanding these dynamics helps investors and businesses navigate currency risk. Conclusion. So here's the bottom line. The U.S. dollar remains strong, not because the world is thriving, but because investors still see the United States as the safest place for capital. For Europe, that strength comes with real challenges, from inflation pressure to slower growth. And globally, it reminds us that currency power is not just about economics, it's about trust. The big question now is this: how long can the dollar stay dominant? And what happens when global confidence shifts? If you want clear, fact-based explanations of global finance without noise or misinformation, hit like and subscribe to Economic Global Brief. This is just the beginning. We'll continue tracking the forces shaping global markets. See you in the next briefing.